Welcome back to Report of Silver. If you are watching the gold and silver markets right now and wondering why prices sometimes move in ways that make absolutely no sense, today's discussion may completely change how you see the financial world. Most investors are taught to watch inflation numbers, interest rates, and central bank announcements. They are told that if rates go up, gold should go down. They are told that silver is just another commodity that moves with industrial demand. But what if that entire framework is incomplete? What if the biggest players in the world are operating by a completely different set of rules, while everyday investors are being distracted by price charts and short-term headlines? That is exactly what appears to be happening right now. Under the surface of the global financial system, a major transition is taking place. It is not being loudly announced on television. It is not making front-page headlines every day. But central banks, sovereign wealth funds, and major governments are clearly preparing for something much bigger than a normal market cycle. They are accumulating physical gold at record levels. In some cases, they are also increasing their exposure to silver. They are repatriating metal from foreign vaults and bringing it back home. They are building alternative payment systems outside the traditional Western financial structure. And perhaps most importantly, they are quietly reducing their dependence on U.S. treasuries. That should make every investor stop and ask one very important question. What do they know that the public does not? Let's start with one of the biggest misconceptions in financial markets. For years, mainstream analysts have repeated the same argument. If inflation rises, central banks must stay aggressive, interest rates stay high, and therefore gold should struggle. It sounds logical on paper, but reality tells a different story. Over the last several years, even as interest rates moved sharply higher, gold continued climbing. In fact, it performed far better than many expected. That alone should tell you something important. Gold is not simply reacting to interest rates. It is reacting to trust. Trust is the real story. Gold rises when confidence in the system begins to weaken. And right now, that trust is being challenged on multiple fronts. Governments around the world are watching debt levels explode. They are watching currencies lose purchasing power. They are watching geopolitical tensions rise. And they are asking themselves a difficult question. If another major crisis hits, can we trust the current system to protect our reserves? For many countries, the answer appears to be no. That is why China has become such an important example. While prices were being pushed lower earlier this year, China did not panic. It did not step away from the market. It did the opposite. It bought more. Official data showed another major increase in gold purchases. At the same time, silver imports surged to record levels. Think about that carefully. While retail investors were being scared by falling prices, one of the largest financial powers in the world was aggressively accumulating physical metal. That tells you something critical. Price is not always information. Sometimes price is misdirection. Large institutional players understand this very well. They know that short-term price weakness can create opportunity. When leveraged traders are forced to sell, stronger hands step in quietly and buy. That has happened repeatedly throughout financial history, and it appears to be happening again. Now let's look beyond China. Poland has also become one of the most aggressive gold buyers in the world. India continues to increase reserves while maintaining one of the strongest cultural connections to precious metals anywhere on Earth. Central banks across Europe, Asia, and the Middle East are all showing the same pattern. They are not reducing gold exposure. They are increasing it. Why? Because gold carries no counterparty risk. That phrase matters more than most people realize. If you hold a treasury bond, you are trusting the issuer. If you hold bank deposits, you are trusting the banking system. If you hold digital reserves abroad, you are trusting another government's legal system. But when you hold physical gold in your own vault, there is no middleman, no promise, no dependency. It is yours. That kind of security becomes extremely valuable in uncertain times. And uncertainty is exactly what the world has right now. Rising geopolitical tension, massive sovereign debt, growing trade fragmentation, new payment systems being built outside Western influence. This is not a temporary news cycle. This is structural change. That is why gold and silver are becoming so important again. Silver, in particular, may be one of the most misunderstood opportunities in the market today. It is not only a monetary metal like gold. It is also a critical industrial resource used in solar technology, electronics, batteries, and artificial intelligence infrastructure. That gives it two powerful demand drivers at the same time. Monetary demand and industrial demand. And if supply tightens while both of those forces accelerate, the result could be explosive. That is why you need to pay attention, not just to price, but to behavior. What are the biggest players doing? What are central banks buying? What metals are leaving exchanges? What assets are governments bringing home? Because those actions tell the real story. And right now, the real story is becoming impossible to ignore. The world's most powerful financial actors are preparing for a different kind of future. A future where trust in traditional systems may not be enough. A future where physical assets matter more. A future where gold and silver may once again sit at the center of global finance. And this may only be the beginning. As we go deeper into this story, we need to focus on something that most investors rarely think about. Why are countries suddenly bringing their gold back home? At first glance, that may sound like a small technical detail, but in reality, it may be one of the strongest warning signals in global finance today. For decades, many countries stored large portions of their gold reserves outside their own borders, mainly in places like Federal Reserve Bank of New York and the Bank of England. There was a practical reason for that. Those locations gave governments easy access to major trading centers like COMEX and the London Bullion Market Association. It made buying, selling, and leasing gold more convenient. It was efficient. It was accepted. And most importantly, it was trusted. But that trust is changing. Around the world, countries have started asking a very uncomfortable question. What happens if we need our gold and someone tells us we cannot have it? That question became much louder after the sanctions placed on Russia and the freezing of foreign reserves. Whether countries agreed with those actions politically or not, many governments immediately understood the financial message. If sovereign reserves can be frozen once, they can be frozen again. That realization changed everything. Suddenly, gold stored abroad no longer looked as safe as it once did. That helps explain why we began seeing a wave of repatriation. Germany was one of the earliest major examples. It requested the return of a significant portion of its gold reserves. That move caught global attention because Germany is not a small player. It is one of the largest economies in the world. When a country like that says, "We want our gold back," people notice. Then others followed. Austria moved. Hungary moved. Poland moved. The Netherlands moved. India also moved a significant amount of gold back under domestic control. One by one, countries began making the same decision. They were willing to sacrifice convenience for security. That should tell you something powerful. These nations were effectively saying, "We trust physical possession more than paper promises." That is not a minor change in strategy. That is a complete shift in mindset, and it connects directly to what we are seeing in the broader precious metals market. Central banks are not just buying more gold. They are insisting on ownership. They want direct control. They want metal in their own vaults, under their own laws, protected by their own institutions. Why? Because physical possession removes counterparty risk. That term may sound technical, but the idea is simple. If your wealth depends on someone else's promise, you carry risk. If that promise fails, your asset can disappear. Gold held directly eliminates that problem. Now think about what that means in today's environment. Global debt is exploding. The United States alone continues adding trillions of dollars in obligations. Interest expenses are rising rapidly. Bond markets are becoming more unstable. Confidence in fiat currencies is being questioned more openly than it has been in decades. At the same time, geopolitical trust is deteriorating. Countries that once assumed cooperation now worry about sanctions, trade restrictions, reserve freezes, and financial pressure. Even allies are beginning to think more defensively. That creates a very different world. In that world, gold is no longer just an inflation hedge. It becomes strategic insurance. And once you understand that, central bank behavior suddenly makes perfect sense. But now let's bring silver into the conversation, because silver may be quietly following the same path. Unlike gold, silver often gets treated like a smaller, more volatile cousin. Many investors see it as speculative, something traders buy when they want more upside. But that view misses the bigger picture. Silver is a monetary metal too. For thousands of years, silver served as money alongside gold. It was trusted globally. It was recognized universally. It held value across cultures and civilizations. That history still matters. Today, silver has a unique advantage that gold does not. It has enormous industrial demand. It is essential for solar panels. It is used in electric vehicles. It powers advanced electronics. It supports data infrastructure. It is part of the global energy transition and the technological revolution. That means silver demand is being pulled from two directions at once. Investors want it for monetary protection. Industry needs it for production. That combination can create very powerful supply pressure, and that pressure may already be visible. We have seen unusual physical deliveries from major exchanges. We have seen record imports into countries like China and India. We have seen physical inventories decline in some markets even when prices were weak. Again, notice the pattern. Weak price, strong buying. That is exactly what sophisticated buyers do. They use weakness to build positions. They understand that markets often move emotionally in the short term, but structurally in the long term. That is why watching price alone can mislead you. The smarter question is this: who is taking delivery? Who is removing physical metal from the system? Who is converting paper claims into real ownership? Those are the questions serious investors should ask. Because when countries start demanding their own gold back, and when physical silver keeps leaving exchanges, it suggests something deeper than normal market behavior. It suggests preparation. Preparation for a future where possession matters more than promises. And if that future arrives faster than expected, today's prices may look very different in hindsight. Now let's move to what may be the biggest structural change happening in global finance today, the quiet creation of an alternative financial system. This is where the story becomes much bigger than gold, much bigger than silver, and much bigger than simple market speculation. What we are talking about here is the possibility that parts of the world are preparing for a parallel economic system, one designed to operate outside the traditional Western financial structure. For decades, the global economy has largely run through one dominant framework. International trade was settled mostly in US dollars. Energy transactions moved through the petrodollar system. Cross-border payments depended heavily on SWIFT. Foreign reserves were often held in US treasuries. This system gave the United States enormous financial power because it controlled the rails of global finance. But what happens when countries decide they no longer want to rely entirely on those rails? That is exactly what appears to be happening. China has been leading this effort. It has spent years building alternative payment infrastructure, including cross-border interbank payment system, often called CIPS. This system allows countries to settle transactions directly in yuan rather than routing everything through the dollar system. On its own, that might sound technical, but strategically, it is extremely important. Why? Because control of payment systems equals power. If you can settle trade without needing the dollar, you reduce dependence on the United States. If you reduce dependence on the United States, you reduce exposure to sanctions, political pressure, and financial restrictions. That is why this matters. And it is not just China acting alone. Groups like BRICS have openly discussed expanding trade settlement in local currencies. Countries in Southeast Asia are increasingly exploring regional financial cooperation outside traditional Western frameworks. Energy exporters in the Gulf are also participating in new bilateral agreements that bypass the dollar in certain transactions. This does not mean the dollar disappears tomorrow. That is not the point. The point is erosion. Little by little, every trade agreement settled outside the dollar reduces future demand for dollars. And if fewer dollars are needed, fewer U.S. treasuries may be needed as reserve assets. That changes the long-term equation. Now here is where gold enters the center of the story. If countries move away from the dollar, they still need a trusted neutral reserve asset, something no single nation controls. Gold fits that role perfectly. It has thousands of years of credibility. It is politically neutral. It cannot be printed. It cannot be digitally erased. It can settle trust where trust is lacking. That is why many analysts believe gold is becoming the silent anchor of this emerging multipolar world. But the strategy appears to go even further. China has been expanding the role of the Shanghai Gold Exchange and related precious metals infrastructure. New vaulting systems are being discussed or developed across major trade routes. Hong Kong remains a key export gateway for gold leaving China. Reports continue to point toward expansion into Gulf states and Belt and Road partner regions. Why build all that infrastructure? Because infrastructure creates optionality. It allows countries to settle trade in local currencies and then convert balances into physical metal. That means they do not need to hold large dollar reserves to feel secure. They can hold gold instead. That is a very different model from the one that dominated the last 50 years. And this is where silver becomes increasingly interesting. Most people understand why central banks buy gold. That story is now widely discussed. But silver is less obvious, and because it is less obvious, it may be more undervalued. Silver could become a strategic resource in two separate ways. First, like gold, it has monetary history. It has served as trusted money across civilizations. Second, unlike gold, it is indispensable to modern industry. Think about the future economy for a moment. Solar panels need silver. Electric vehicles need silver. Advanced electronics need silver. Artificial intelligence infrastructure needs silver. Medical technologies use silver. Military applications use silver. That means silver is not optional. It is necessary. Now combine that industrial demand with growing investor demand and sovereign interest. What happens if all three intensify at once? You get a supply problem. And supply is already tight. A large percentage of global silver production does not come from primary silver mines. It comes as a byproduct of copper, zinc, and lead mining. That means silver supply is often dependent on decisions made in entirely different industries. If copper production slows, silver production can slow too. That creates vulnerability. And while this is happening, physical silver has been leaving major exchanges in unusually large volumes. Deliveries have been stronger. Inventories have been pressured. Imports into Asia have surged. Again, the pattern repeats. Paper prices wobble. Physical demand strengthens. That disconnect should get your attention. It suggests that sophisticated buyers may be using temporary price weakness to quietly build long-term positions. This is why understanding the bigger system matters. If the world is moving toward a more fragmented, multipolar financial structure, one where local currencies matter more and neutral reserve assets matter more, then gold and silver are not just investments. They become strategic assets. That changes how you should think about them. They are no longer just about inflation. They are about sovereignty. They are about resilience. They are about independence. and the countries that seem to understand this best are already acting on it. The question is whether individual investors will recognize the shift before the rest of the market fully prices it in. Now let's talk about silver more directly, because if gold is the metal central banks openly discuss, silver may be the metal they quietly accumulate while the public is distracted. In many ways, silver is becoming one of the most fascinating and misunderstood assets in the world today. Most investors still look at silver as a smaller version of gold, something more volatile, more speculative, and more unpredictable. But that old way of thinking may be dangerously outdated. Silver is now sitting at the intersection of two massive global trends, and that combination could create one of the most powerful supply and demand imbalances we have seen in years. The first trend is monetary demand. As trust in fiat currencies weakens and sovereign debt continues to rise, investors naturally start looking for hard assets. Gold usually gets most of the attention because it has always been viewed as the ultimate store of value. But silver benefits from the same psychological shift. When people begin questioning paper money, they often turn to precious metals, and silver becomes the more affordable entry point for millions of buyers worldwide. That creates a broad base of demand that can grow very quickly during times of financial uncertainty. But silver has something gold does not have. It has a second demand engine, and that engine is industrial consumption. Silver is absolutely critical to modern technology. It is essential in solar panel manufacturing, where it plays a central role in energy conductivity. It is used in electric vehicles, advanced batteries, semiconductors, telecommunications equipment, and the growing infrastructure needed to support artificial intelligence. Every new data center, every new electric grid upgrade, every new renewable energy project increases silver demand. That means silver is not just benefiting from fear. It is benefiting from technological progress. Now think about what happens when both of those forces accelerate at the same time. On one side, investors buy silver because they want financial protection. On the other side, industries buy silver because they physically need it to manufacture products. Those two forms of demand compete for the same limited supply. That is where the story becomes extremely interesting, because silver supply is not as flexible as many people assume. Most people think if demand rises, mining companies can simply produce more silver. But that is not how the silver market works. Only a small percentage of global silver production comes from mines that are specifically searching for silver. Most silver is produced as a byproduct of mining other metals, especially copper, zinc, and lead. That means silver output often depends on whether companies are actively mining those base metals. If copper production slows, silver production often slows as well, even if silver prices rise. That creates a hidden vulnerability in the market. And there is another problem developing beneath the surface. Physical silver inventories appear to be tightening. We have seen unusually large deliveries leaving major exchanges like COMEX. Historically, very few traders ever stood for physical delivery. Most contracts were settled financially. They were used for speculation or hedging, not for taking actual metal. But recently that pattern has changed. Large volumes of silver have been delivered and in many cases removed from exchange systems entirely. That should raise a serious question. Who is taking that metal? Someone with very deep pockets is standing for delivery and moving physical silver into private hands. That is not normal retail activity. That is strategic accumulation. At the same time, countries like China and India have imported extraordinary amounts of silver. China recently posted record import numbers even while prices were under pressure. India has reportedly absorbed hundreds of millions of ounces over recent years. These are not emotional trades. These are calculated decisions. And again, this brings us back to a critical idea. Price can be misleading. When prices fall sharply, most investors assume demand is weak. But in precious metals, that is not always true. Sometimes falling prices are caused by leverage unwinding, ETF rebalancing, or futures market pressure. During those moments, sophisticated buyers often step in and buy aggressively. They understand that paper markets can temporarily distort price, but they also know physical supply cannot be created out of thin air. That difference between paper and physical matters enormously. A futures contract is a promise. Physical silver is possession. When trust in financial systems starts to weaken, possession becomes more valuable than promises. That is exactly why silver may be entering a very different phase. For years, it has been overlooked, manipulated, and misunderstood. Many investors became frustrated because the price did not reflect what they believed fundamentals should support. But markets can stay disconnected for long periods before reality catches up. When reality does catch up, it often happens fast. That is why some analysts believe silver could outperform gold in the years ahead, not because gold is weak, but because silver's upside potential may be greater due to its smaller market size and tighter supply conditions. It does not take nearly as much money to move silver dramatically higher. If institutional demand increases, while industrial demand remains strong, price adjustments could be sharp. And remember, this is happening during a period when governments are already preparing for greater financial uncertainty. They are buying gold. They are reducing treasury exposure. They are building alternative payment systems. They are repositioning for a world where trust is no longer automatic. If that trend continues, silver may not stay ignored for much longer. The market may still be treating silver like a secondary metal, but the physical world is beginning to treat it like a strategic resource. And when markets finally recognize that shift, the revaluation could be far more dramatic than most people expect. As we close this analysis, we need to step back and look at the bigger picture, because what we are witnessing is not just another cycle in gold and silver. It may be the early stages of a much larger transformation in the global financial system. Markets often look chaotic on the surface. Prices move up and down. Headlines create emotional reactions. Analysts argue over inflation, interest rates, and central bank policy. But beneath all of that noise, deeper structural shifts are often taking place quietly, and those who recognize them early are usually the ones who benefit the most. Right now, one of the most important signals to watch is the U.S. 10-year Treasury yield. Most people do not pay much attention to it, but it influences nearly everything. It affects mortgage rates, business borrowing, government financing, bank balance sheets, stock valuations, and global capital flows. In many ways, it is one of the most important prices in the world, and that is exactly why it matters. If Treasury yields continue rising while government debt keeps expanding, pressure builds across the entire system. Banks feel it. Real estate feels it. Pension funds feel it. Insurance companies feel it. Governments feel it. Highly leveraged markets become vulnerable because the cost of money becomes more expensive. That is where risk begins to spread. We already saw a glimpse of this when higher rates caused stress in parts of the banking sector. That was not a random event. It was a warning. It showed how fragile heavily leveraged systems can become when borrowing costs rise too quickly. Now imagine that pressure continuing. Imagine debt growing faster than economic output. Imagine interest expenses becoming one of the largest items in national budgets. Imagine investors beginning to question whether governments can realistically manage those obligations without printing more money. That is when confidence starts to weaken. And once confidence weakens, people begin searching for protection. That brings us back to gold and silver. For years, many investors viewed precious metals as optional. Something nice to own, perhaps, but not essential. Today, that perception appears to be changing. More people are starting to see gold and silver not as speculation, but as insurance. Insurance against what? Against currency debasement? Against sovereign debt problems. Against banking instability? Against geopolitical shocks. Against declining trust. That last one may be the most important of all, because trust is the foundation of every financial system. Money works because people believe in it. Banks work because depositors trust them. Governments borrow because investors trust repayment. Reserve currencies dominate because nations trust them. But when that trust begins to erode, even slowly, the system changes. And that is exactly what central banks appear to understand. They are not buying record amounts of gold by accident. They are not repatriating reserves by coincidence. They are not reducing treasury exposure without reason. They are preparing. That does not necessarily mean a crisis is tomorrow. It does not mean the dollar suddenly disappears. It does not mean financial collapse is guaranteed. But it does mean the smartest institutions in the world are adjusting their strategy, and that should matter to you. Because retail investors often react after trends become obvious. Institutions move before they become obvious.